Hello everyone, welcome to this video. In this video, I'd like to talk to you about the possible interest rate hike of the Fed, the Federal Reserve System, which is a different name for the Central Bank of the United States of America. Why do I want to talk about this topic? Well, because it frightens so many people, because the interest rates that the Fed sets automatically affect the global economy. Especially it does affect emerging economies, but particularly also it affects the stock market, gold, and cryptocurrencies. So without any further ado, let's jump into the topic. Why would the Fed increase its interest rates, and what will it lead to? So first things first, why would the Fed increase interest rates? Well, it's all related with how central banks work. The Fed is a central bank, and its core purpose, why it exists basically, is to contain inflation, which is a different name for your money losing its value. Think about it. You go to the supermarket, you're going to do grocery shopping, and in 2 years from now you have to pay more for the same product. It does not per se have to be 2 years. It can also be 1 month. It can perhaps even be the next day. Point is that for the same product that didn't change at all, you have to pay more. And this means, of course, that if the product doesn't change, if you have to pay more, it means that your money became less of value. And this whole thing, this concept of your money becoming less of value, the Fed, any type of a central bank, wants to contain. It's of course related to demand and supply. If the supply of something, of products, kind of stay the same, if the demand for it rises, this means of course that prices will be hiked accordingly. So inflation by definition is not really a problem per se. It's about how high the inflation is, right? So inflation is the pace with which your money loses its value, and if it is approximately 2% or so for developed countries, then this is fine, because you know that kind of the prices are going to be the same today, tomorrow, in a week from now, in a month from now, but at some point prices will increase, and that means that whenever you need something, you still will be tempted to go and buy it, because at some point it might be more expensive. So a decent level of inflation for developed economies is about 2%, because they tend to grow a bit less fast, and for emerging economies about 5%, because they grow faster and can compensate for this. This is kind of okay. There's also the flip side of deflation, and that's also something that the central bank wants to contain, because deflation is kind of a problem. When there's deflation, it actually means that your money becomes more of value vis-a-vis the products that are out there. Tomorrow everything is going to be cheaper, and the day after that is going to be even cheaper, and that means that you're not going to spend your money because you're going to wait for things to become cheaper and cheaper and cheaper. If there's a mechanism that's going to motivate you to keep on spending your money, which is a reasonable level of inflation, this is good, because it helps the economy grow. But if there's this mechanism like deflation that's actually going to withhold you from spending your money, then this is of course going to hurt the economy as you're waiting and waiting and waiting to spend your money, and that's a problem. So this is also something that the central bank wants to contain. So in the case of inflation, if there is inflation, the central bank can use the interest rate mechanism. If there's deflation, also the central bank can use its interest rate mechanism. Now let's talk about this mechanism a bit more. Let's start from deflation, what we talked about at the end. So if there's deflation, meaning that everything becomes cheaper, what the central bank can do, what the Fed in this case can do, is drop the interest rates, right? It's going to actually make sure that your consumption becomes cheaper. You can take cheaper credits to spend, right? Production becomes cheaper. Firms that want to produce can produce so by getting money much cheaper, buying cheaper machines, making much cheaper investments, and this is more lucrative. So companies in this case are also of course going to spend, and if you then have consumption, production and investment rise, then with this, of course, demand is going to rise, and deflation then hopefully tips over to inflation, to the 1%, 2% that we actually want to see. And side effect of this, of decreasing the interest rates, of course, that also foreign money, foreign investors don't want to invest their money in your country because they get less interest for putting their money in your country. And this means that as there's less demand for your currency is going to be less of value, and as it is less of value, the import of your country is going to become cheaper, more expensive, and this of course also going to lead to price increases rather than decrease, and also this is going to break through the deflation mechanism. And so decreasing the interest rate, because it spurs spending, production and investment, and because it makes your imports more expensive, all of this leads to an increase of prices. So deflation is that. So if we talk about inflation, if you want to contain inflation that's too high, then of course the opposite counts, right? In this case, you may want to increase the interest rate. Why? Well, if you increase the interest rate, then what's going to happen is that consumption becomes more expensive because consumer credit becomes more expensive, production becomes more expensive, investment becomes more expensive, because also credit for companies, of course, becomes more expensive. If you think about the foreign mechanism that we also just talked about, if you increase the interest rate, it becomes more lucrative for foreign investments to stall their money in your country. And with that, as they want to stall money in your country, there's of course going to be more demand for your currency, right? Because they're going to want your currency to get interest over it. And when that's the case, it also means, of course, your money becomes more of value, right? It appreciates. With this, imports, of course, become cheaper, and of course this is also going to lead to suppressing the inflation, because cheaper imports also means that people can of course suppress the prices. So if you think about all of this, about the deflation and the inflation, now we have to talk about kind of the situation in which we are in. So if you think about the United States of America, about the whole world, basically, we're in a pandemic, right? At least when this video is shot, we're in a pandemic. But in other situations, there might be other things. In this case, there's a pandemic, and the pandemic has led, of course, to the economy to slow, right? The United States of America, just like any other country, people could not go outside, right? They could not walk as they wanted. They could not spend as they wanted. Companies were kind of scared of, what's going to happen. Should I keep on investing in my business? In some cases, companies could not even function, right? Because there were curfews, there were lockdowns, manufacturing plants had to shut down, and so on. So all of this, of course, led to economies to slow down. And if economies slow down, that's of course a big problem. Sometimes companies were going to go bankrupt, people couldn't reach the end of the month in terms of their spendings, and so on. So this is a problem. Then, of course, what economies did was put money into the economy. So putting money into the economy means that you're going to print money, or you're going to have cheap loans. You're going to make sure that people have money in their hands that they can spend. And with this, the economy is of course going to flourish. You're going to help companies. You're going to help people. In the end, spending is one of the backbones of the economy. So if you spend all of that money, the cheap credit or the money that was printed, or whatever, at least money in one way or another put into the economy. You can also think, for example, about the stimulus checks that the United States gave to its people. If you think about all of that, then you get this flooding of the market in terms of money that wasn't there yet, suddenly brought into the economy. This means that demand, compared to the supply, demand is going to increase so much faster and so much more, which leads, of course, to price hikes. If the supply of something stays the same, And you know, if you think about production and investment, you know, it takes time to increase production. And so if production kind of stays the same, if you give cheap credits, if you print money, you suddenly have with that so much more demand for those products, it means that price increases. If you keep this aside, even as we are going slightly towards the end of the pandemic, even in such a situation also, you will see that people start spending more than they used to. And also this, aside from the money printing and the cheap credit factor, is also a reason why you see more demand, and the demand suddenly increasing so much faster than supply increases. Both mechanisms, money printing, cheap credit on the one side, the end of the pandemic coming close and people starting to spend money, both mechanisms lead to inflation. Of course, the general spending money mechanism is related to a reduction of the uncertainty, people knowing what's going to happen, and people feeling comfortable to spend money once again. And spending, one way or another, if it is faster than that supply can match it, leads to price hikes, which basically is the definition of inflation. If your income does not increase as fast as inflation increases, it of course leads to poverty. So the problem here is that in the United States, this inflation is reaching proportions that wasn't seen for quite a long time ago. 2% is okay. But if, because of all of this spending, if suddenly inflation is not 2 but 5%, and if it goes to 10%, then what you're going to see is that people cannot see the future. They don't know what prices are going to be in the future because it's an inflation that they were not used to. Companies similarly don't know how much they have to compensate their workers, what price they have to ask for their products to not lose income, to costs, because the company also has to import, has to produce. All of that also has costs related to inflation. In such a situation where the inflation is high, it affects people, it affects companies, simply because you don't know what's going on, how long that inflation is going to last. If 2% is what you want, can you really get to the 2%? Fluctuating inflation is even worse, but high inflation, even, especially for companies, is a problem, because workers have to be compensated, new products have to be brought in, there has to be money to be paid for as well. In the worst case scenario, you have to fire people, or you will put new recruiting on hold. All of this is a big problem. And why are we now talking about the Fed possibly increasing the interest rate? Well, we are talking about that simply because this inflation currently in the United States is really, really going sky high. And the question is whether this is temporary, whether it's permanent. But if it is permanent, Fed will have to act on it and will have to increase the interest rate to contain the inflation to the level of about 2% that it wants to be. If it is temporary, the Fed may want to wait it out and see whether it's going to go to the 2% by itself. But that's the discussion that we're currently seeing. Should the Fed act on it, or should it not act on it? And if it acts on it, well, then we're going to see some effects that we're now going to talk about. So if the Fed decides to hike the interest rates, what's going to happen? That's the question, right? So first of all, it is the question of how much is the Fed going to hike it. If it is a small hike, then who cares? If it is a big hike, well, then we're having some issues here. Especially also, what is the term of this big hike, right? Is it suddenly going to, because now the Fed's interest rate is close to zero, right? 0.25%. If it is going from 0.25 to 2 directly, then of course this is like a break on the economy, right? Suddenly everything becomes more expensive, right? Consuming, producing, investing, everything becomes more expensive. If it does not stop at 2 but goes to 5, the interest rate and whatever. So it's not just about how much is the interest rate going to be hiked, but also in what type of a time period. And these two together, of course, are going to determine the magnitude of the effect of an interest rate hike. So putting this aside, because we don't know this, but let's just talk about what happens if the Fed decides to increase the interest rate, because it's not just the US that we're talking about, right? In the US, sure, consumption is going to decrease, production, investment, sure, and with that, inflation is going to be contained. We kind of talked about that. So that's the effect on the US economy. The US economy is going to slow down in terms of economic growth, sure. But if you think about the fact that the US economy is the biggest, or one of the biggest, depending on, of course, how you calculate GDP, but kind of undoubtedly the most important economy nowadays, if this economy slows down, of course, it's going to drag down with it the rest of the world. Because if the US, if people there start to consume less, the US is going to import less because there's less consumption. If the US starts to invest less, then other types of companies that are buying stuff from the US or who may want to invest in the US, those are also going to be hurt in terms of the return on their investment, or in terms of them not being able to import what they need to import for further production in those other countries, right? If you think about production in general, if the US starts producing less, you're going to be able to export much less to the US, and also this is going to hurt a lot of export dependent countries. And with that, if the US economy slows down, the rest of the world slows down with it. And this is quite tricky because it can lead to a domino effect, where the US, if it really pulls the handbrake, if it is really going to slow down a lot in a very short time span, it can drag down the whole world into a global recession. And that is not something you want, especially not while the pandemic is still kind of around. We're not out it yet. If now you're going to get into a recession, well, then what, right? How are you going to support the global economy? If you're going to print more money, or if you're going to, provide cheaper funding, to people, to companies, well, then that's again going to exacerbate the inflation problem. So you cannot do that. Also, the amount of money you have is finite, right? Perhaps not for the US, because it is, it controls the dollar, and with that, the most important money around. And so because of that, the US printing money or providing a lot of cheap money, it hurts the US much less, because there's so much demand for the US dollar that a small increase in the US dollar due to domestic use is going to have a less big impact on the inflation in terms of the United States. But think about a smaller country that, because of a global recession, may want to support its economy. If it starts printing money, or if it starts supplying a lot of money to the economy through its reserves, there's an end to this. Either the inflation is going to go sky high, or its money is going to deplete. And what do you do in that situation? Borrow more. With that, your interest costs are going to hike. And then after the pandemic, you have this massive debt and interest burden, right? And these are all things to consider. Biggest problems are most likely for emerging economies. Why? You might say, well, if the United States of America hikes its interest rate, it automatically also means that the dollar is going to appreciate with it, right? There's going to be more demand for the dollar. It's the strongest, kind of most stable in terms of its survivability, and also in terms of global demand for it, right? The best currency there is to invest in if you want to have an interest income out of currency. And so if the United States of America hikes the interest rate, then the dollar becomes more lucrative to hold, because the dollar is already kind of the global reserve currency. There's going to be this demand for the dollar, and with this, the dollar is going to appreciate in value. So you know this. But what's this going to lead to? Well, if the dollar appreciates, then it means that everything that you import using the dollar, or any debt that you get in terms of the US dollar, or any debt that you already have in terms of the US dollar, is all going to increase in value, right? Your own currency becomes less of value compared to the US dollar. So your US dollar based imports are going to go up. Your debt in terms of the US dollar is going to go up without you doing anything, right? It's just that the Fed hikes the interest rate, and all of these effects on emerging economies suddenly pop up. The problem is here that emerging economies are very import dependent. They import a lot. And a lot of that is, of course, based on the US dollar. A lot of that is from the US. And this is going to hurt the global economy in terms of having more expensive imports. Another thing that comes on top of this is that the people who want to have the US dollar to invest in the dollar and with that to get interest income, they're going to sell emerging economy currencies. As they sell those, it's not just that the US dollar is appreciating, but as the US dollar is appreciating, emerging economy currencies don't appreciate with it, and so if there's not a par, emerging economy currencies depreciate at the same time. And then you see that not only imports based on the US dollar, but any type of an import suddenly becomes more expensive. And if you are an import dependent economy, well, then you have a big problem, because to keep your economy going, you have to import, but your imports are becoming more expensive. And so the same stuff you have to pay more money for. And of course, this is going to have a high burden on your current account, on your balance, and you might have to support it with your reserves enough, can you deal with this, and so on and so on and so on. This is also a problem. And as said, your debt, which often is based on or is counted or gotten in terms of the US dollar, because it's kind of the global reserve currency that we talked about, your US dollar based debt is also going to appreciate compared to your own currency. And that's also yet another problem that you will be facing as an emerging economy when the US dollar appreciates in value because the Fed hiking the interest rate. So in general, what you will see is that emerging economies will have a bigger debt burden. They will slow in terms of their economic growth, and so their competitive situation will be worse off because of the US dollar hiking the interest rate. So the final effect that I would like to talk to you about of a possible US interest rate hike is about the effects of this rate hike on the stock market, on gold, and on cryptocurrencies. Now let's start from the start. So the moment that let's take it even one step back. So the interest rate, why is it high? In the past, of course, it was high because of the US and China, right? There was a trade war going on. There were some problems over there. Then we have the pandemic. Then we have some other issues with respect to Russia, with respect to the Suez Canal. So all of these sensitivities, all of these dilemmas, all of these fights and battles, what did all of these lead to? Economies slowed down, and as economies slowed down, uncertainty increased, right? So this is kind of the period that we have been through since, let's say, in the last 5 years. We have seen the US-China trade war, we have seen a pandemic, and we have seen issues between issues between, not per se, but in general, we've seen issues related to Russia, cybersecurity, meddling in elections, allegedly, and of course also issues that we saw around the Suez Canal that we've only seen recently. All of these issues have led to uncertainty, and of course, uncertainty has its effect on a lot of things, right? So if you think about these uncertainties and the effect on spending, on investment, and on trade, all of the effects, of course, are negative, right? If there's more uncertainty, if you don't know what's going to happen, you may want to hold on to your money, you may want to invest less, you may want to trade less because you're waiting to see what's going to happen. And in such an environment, what we saw is that for a long time, interest rates kept on decreasing, right, to compensate for this, to keep the global economy going. We saw that, cheap credit has been given, money has been printed simply to keep the global economy going. What happens in such a situation when there's a low interest rate, when low credit is being given, low interest rate credit, when money is being printed? Well, you get a lot of supply of money, right? A lot of money is out there, and with this money something needs to be done. And what happened with this money is that all of this money moved into the stock exchange, moved into gold, it moved into cryptocurrencies, into the stock exchange. In terms of cryptocurrencies, perhaps it's easier to understand. You want to invest somewhere, so you invest it in the stock exchange or in cryptocurrencies. Gold might be perhaps a bit more difficult to understand. With gold, the thing is that if there's uncertainty, you want something to hold value. Gold's values of itself, we know how much gold is there in the world, gold is not being printed, and so in such a situation where there's uncertainty, gold becomes interesting to hold. And so as there's a lot of money in supply, and as the reason for this is uncertainty, people have moved towards gold. But because it was a mixed situation where economies still kind of kept on going, because economies were supported, right, by cheap credit, by money printing, we saw also money moving into the stock exchange, right, because there's low interest rates. Where else are you going to put your money? You cannot put it on the bank. There's not much money to get from that. You know, gold, okay, nice, but it does not have a yield, right? You don't get an interest income over gold, so people also put their money on the stock exchange. Cryptocurrency is also interesting. Cryptocurrencies are kind of also related to gold when there's uncertainty, especially related to the financial market. You see money moving into cryptocurrencies because the reason why cryptocurrencies, of course, came to the forefront is because of distrust, inconvenience with respect to the financial markets. In such a situation, you oftentimes see that money moving into cryptocurrencies, as a counterbalance to things going wrong in the more traditional financial markets. And so, if interest rates are low, if there's uncertainty, if the financial markets have a risk of not going well, just because of also the things I talked about, possible Fed interest rate hikes and so on, then you see there's a demand for, moving into cryptocurrencies. And so it did. Money really moved also into cryptocurrencies, and that's why you also saw, Bitcoin breaking record after record. So what will happen if the United States in such a situation hikes the interest rate? Well, then you're going to see, the effect really flip. You're going to see the stock exchange fall, plummet. You're going to see gold plummet, and you're going to see cryptocurrencies plummet. Why? Well, because the US dollar, valuable as a currency, stable. You can see the future. There's not that much risk related to it. So if you can have a decent interest income and just holding the US dollar, and if that's even higher than, for example, the inflation, great. Then people are going to buy the US dollar and do some investments with that. But they're especially so going to make investments with which they can get interest income. And so if you can get interest income, first of all, you're going to ditch gold, because with gold you don't have interest income values of itself. It does not appreciate, does not depreciate. Money becomes more or less of value, and that of course resembles to the value of gold. So first of all, gold is going to plummet because people are going to sell gold and buy the dollar. Then people are also going to put less money on the stock exchange and less money in crypto exchanges, because both are risky, volatile. If you can just guaranteed get interest income from just holding the dollar and putting it on the bank, great, why not do that? And that's what a lot of people will also do. And with that, they'll start selling stocks, and they will start also selling cryptocurrencies in favor of holding the US dollar. And with this, what you will then see is that as the stock exchanges, as gold, and as cryptocurrencies hold a lot of the wealth of the global population, a lot of people will lose their wealth, and this of course reflect into less consumption, less investments, less production. So this is really going to hurt the global economy if this really goes too fast. And on top of the handbrake function that it will also have on global economic activity, it is safe to say, I think, that an interest rate hike of the Fed can have really disastrous effects on the global economy if it is too big too soon. So let's see together what's going to happen. I hope I enjoyed the video. I hope it was of benefit to you. If so, please don't forget to hit the like and subscribe buttons. I wish you all the best in the world and hope to see you again anytime soon. Take care.